Buytolets are the foundation and cornerstone of the property investment world. Most people get confused by it, whether it's for beginners, whether it's for intermediate or advanced. And the truth is, it's the foundation of everything we do in property investment. It has to play a core role in everything we do. And in this video, I'm going to be covering all of the basics that you need to understand and covering the key steps of maximizing your profit in 2020 and 2021 in your property investment career. So for those that don't know me, my name's Jamie York. I've been investing in buy-to-let property now for the better part of a decade. I've built up a multi-million pound buy-to-let portfolio, and I'm saying that not to impress you, but to impress upon you the importance of heeding this advice as you start out and move forward in your investment career. And if you're interested in finding out anything around property investment, investment mindset and business, then you're in the right place, and make sure to hit the like button and of course subscribe to this channel so you can be notified as new videos come out on a weekly basis. Okay, so first of all, what is a buy-to-let? So a buy-to-let property investment is probably the most standard form of property investment that you know. So most people look at either a flip or a buy-to-let starting out. So you're buying, refurbishing and renting out a property, or which is a buy-to-let, or you are buying, refurbishing and selling on the property, which is also known as a flip in the UK property market. But this is the same in America if you're watching from the States, and anywhere in the world really, with just some slightly different rules. So the overall aim of what we're trying to achieve with a buy-to-let is to use money. It doesn't have to be yours, by the way. It can be OPM, other people's money. That's for another video. But what we're doing is using the money to purchase a property, refurbish it to, or rehab it if you're in America, to a decent level, and then renting out to an individual that wants to make your house their home, hopefully making you a decent profit in the meantime. So one of the key parts of investing in property that, in my opinion, makes it the best asset class out of every single investment is leverage, okay? Safe leverage. So what I mean by leverage is using other people's money to get your asset for you. So the most common of this is a mortgage, right? So a mortgage is the bank giving you money or loaning you money so that you can purchase a property. So for example, let's say a property is 100,000, and if I'm buying it for 100K, that would be 100,000 in cash. That's a lot of money. I mean, £1,000 a lot, but that's a lot of money, right? So I'd have to save up 100,000 to purchase the property, plus legals, plus stamp duty, plus anything that's needed to be done to the property. And instead, what you can do is use the bank's money at a very low rate. Right now it is very cheap. We're talking like 2-3%, to borrow typically 75% loan to value. What that means, a loan to value, is how much loan a bank will give or a lender will give in comparison to the value of the property. Now it says loan to value, but actually it's 99% loan to purchase price. So that'll make sense in step 5. So bear with me and I'll link back to this, okay? So make sure to watch to the end, because that really does maximize everything I'm talking about through here. So the reason you want to take leverage on is it makes your money go further in a relatively risk-free way. Because the reason it's risk-free is if you've got £100,000 property and you've loaned £75,000 of that, I can use £25,000 plus some little bits for the fees, etc. But now I can build that portfolio a lot quicker without overexposure. Exposure is risk, okay? And if you have too much exposure, then you are you potentially at risk of losing the property if there's a down valuation. Right now we are in the middle of Corona lockdown Mark 2. And so realistically, jobs are getting lost, all of that. There's likely to be a market correction. Does that mean you shouldn't buy right now? Absolutely not. A really common objection I get, a really common question I get is, should I be waiting? No, you don't wait to buy property. You buy property and wait. And ultimately, I don't care if there's a little dip in the market. I'm focusing on the return on capital or the return on cash. However, what you don't want to do is over leverage. People at the beginning of their journey get obsessed, literally obsessed with all your money out deals, i.e. I want to buy it, refurbish it, refinance at the highest value possible to pull out all of my money, okay? I'd stop with that obsession. I can understand at the start you want to make your money work as hard as possible, but actually you should be focused on that return on your cash, but that's not the video for this. A lot of people before the last crash, 2007, 2008, what they did is they over leveraged the portfolios. That's the point where people got 100% lending. Some people even got 110% lending, where you'd buy the property and get more so you can pay for a refurbishment. Absolutely crazy, overexposed, and there's always in the small print of a loan saying if it goes below a certain value, so it might be 80% value, we can start calling in the loans. Because you have to think, the reason why mortgage lending is so cheap is because it's asset backed. So if I lend you £75,000, and what I can do if you stop paying is take something from you that is worth £100,000, that's a pretty good and safe investment for me until you over leverage. So leverage is a really important, crucial, some might say, part of building a successful property portfolio, but please don't neglect it moving forward. So when it comes to a mortgage, you're going to come across something called coverage, okay? And a lot of people don't talk about coverage. In fact, I don't think I've ever heard it mentioned on a course or YouTube channel before, but it's a very basic concept. There's something called rental coverage. Now, when you are getting a buy-to-let mortgage, typically you need to have a salary if it's your first one. Usually you need to be on, 25 grand opens up the whole market, but anything above 20 grand opens up some lenders to you. And they're not just basing it on your income or your affordability like it might be with a residential mortgage. What they're actually looking at is, does it make money? And the way they do that is rental coverage, okay? So when you're looking at rental coverage, it is how much does the rent cover the mortgage payment? So for example, if you are getting a, £500 mortgage, and you are getting £600 in a rental, you're getting £100 extra on top of the 500, which is 20%. So the way that they would say that is you are getting 120% rental coverage. So people have a standardized measure. Most lenders are based on 5%, okay? What that means is 5% lending. So if, for example, they are loaning you £100,000, even if they're charging you 2% or £2,000 per annum, they will base it on 5%, a lot of them to be safe. This isn't every lender, but this is a pretty blanket rule, okay? So you need to base it on 5%, and this is called stress testing. So even if you're not paying 5%, you want to pretend that you are, and does it still work as a buy-to-let moving forward? So let's take a typical example. Let's say a £80,000 property and you're going to rent it for £500 a month, okay? So if I rent it for £500 a month, that's £6,000 a year. Maybe we could put something up here. Okay, £6,000 a year. And then if we have £60,000 loan on that, which is what it would be, 75% loan to value, and we are paying 5% on that, that's going to be £3,000 a year. Okay, so we've got £3,000 a year, but we're getting £6,000 a year. That's a 200% rental coverage because there's 3,000s into the 6,000, right? So 200% rental coverage at 5%. Now, to give you an idea, it used to be 125% rental coverage, but it's gone up, okay? So 130% rental coverage, if you're getting it in your personal name, that should be enough, okay? However, a majority of people, thanks to Section 24, which is some tax changes, don't get confused by that. I'll do some separate videos on it. Most people are now purchasing in a limited company to protect themselves. It's best for tax reasons, and a lot more lenders are there. What you want to do is have 150% rental coverage at 5%. So let's just clear that up. 5% is the interest rate you're going to apply. Bear in mind, it's 99% of the time going to be an interest-only mortgage. Okay, so if you're lending 100,000, that's going to cost you 5,000 a year on your stress test, and then you want 150% of that as your rental coverage. So you want to be making 7,500 per year. Okay, 7,500 per year, which is about £650. We'll work it out and put it here. Okay, so the rental amount needs to be 150% more. Okay, so for my final point, what I want to cover is how to actually buy this and what you should be looking for. And we're going to jump over to the screen in a moment just to sort of cover this off so I can give a worked example that's going to be really important for you if you're looking to buy a property in the first place, or if you're using other people's money. And raising finance is going to be a really good pitch for you, and it's going to be great if you are packaging these deals on or selling them on to other people. So what we're going to be looking for is 3 core things. First of all, it's going to be below market value. The next one is it's going to have an opportunity to add value. And the third one is it's going to have great capital appreciation or growth prospects. So we're going to go over to the board in a moment so we can cover all of these. And if you're getting value out of this video so far, make sure to hit the like button. Let me know what you think in the comments. And of course, hit the subscribe and notification bell, and we'll jump across to the board now. Okay, so as I said, we're going to cover these 3 things: below market value. The reason I've written it like this, BMV, is as you get into property, you'll see BMV written down quite a lot. It means below market value, i.e. you are purchasing it below what the current market value is. I'm not going to discuss around that in this video, but it's a very real concept. Next is value add. Are you adding value to it? Usually through refurbishment of the property. And third, capital growth. I'm going to explain why it's so important. So let's go through a scenario, and I've got some scenarios drawn up here, which we'll get to in a moment. Let's say this property is in need of work, but it is genuinely worth 80,000 today. Okay, £80,000 today in value. How can we get a below market value offer? Well, quite simply by getting it for less than 80,000. If you can get it at 79,000, that is £1,000 below the market value, right? Now, obviously, we want more of that, but I don't want to go for an extreme example. Typically, we're getting around 15 to 20% below market value, but it does change with where we're at in the economy right now. So what we're looking for, and a lot of people go, well, why would somebody sell their property below market value? You have to bear in mind, as an investor, you're constantly thinking about the money. As a vendor or somebody selling this property, they are focused on the pain that they're going through right now and the pain relief that they're looking for. Okay, so they are not, their major focus is not on the amount of money that they're getting. So let's say we get this property at £70,000. Okay, so we now have ticked the box for number 1. We've got it below market value. We're then going to refurbish the property and look at some capital growth. So let's go ahead to a worked example. So we purchased the property at 70,000. We're happy because we got it BMV. Yay. Right, so what we're actually going to be looking to do to this is add value. Now, this is massively simplified. You used to see people go, yeah, put in £1 and get out 3. Right, that makes complete sense. Yeah, it doesn't really happen like that. It's like developments. People used to say, buy the land, that's the cost $1 million. Build a property, that cost $1 million. Sell it for 3 million. It's never worked like that. It's never that simple. But in general, you should be able to add value to a property through refurbishment as we're going through. Okay, so we've got £70,000. We're looking, there's going to be fees, some stamp duty, some legals in there. To keep it simple, I've put £5,000 to cover it, and we are going to refurbish the property for the £15,000. Okay, and then totaling all of that totals £90,000. And what we're going to be looking to do through adding value, so now we've ticked and we're double happy because now we've covered number 2 on this list, adding value, we're going to be able to refinance the property at a higher value. For those that don't know what refinancing is, once you've added value and you've got this new value because it's done up beautifully, you can then go back to the mortgage and say, hey, this house is absolutely gorgeous now. Why don't you come and see what you think it's worth now? And they'll go, great, yeah. They don't do any of this, by the way. Coming around, yeah, that's great. I think it's worth more. In fact, I think because you've done such a great job, I now think it's worth 120,000, okay? So now this is an extreme example. of this, but I want to make the numbers easy. So now I think it's worth 120,000. Well, that's great. We've added value, right? We've ticked off number 2. So we've added value. Remember, we're going to refinance at 75% loan to value, which means 90,000 is going to come out, which happens to be 75% of 120. Remember, we are going to stress test our interest at 5%. So 5% of 90,000 is 4,500, which is over a year. So it's per annum. And if you want to work out what that is per month, divide by 12. Then we're going to rent this property typically at about 650, but that's completely dependent on your area. So we're going to get 7,200 in, and then we're going to take off the 4,000 and this 900 in extra costs, so some management and bits like that. So we are going to be left with £1,800. Now this next part, the capital appreciation or capital growth, is the key to your success. Now, you don't want to be reliant on this. This is going to be the icing on the cake, but it's often the thing that a lot of novice investors and even experienced investors really forget about. And this is where the dramatic impact comes in. Okay. So if you did nothing right now, we're going to make £1,800. Okay, now that's great because you might go, well, that's brilliant. I've got my money out and I'm going to make some money. However, this is the power of capital growth. So if you're careful about selecting your area, so you're not doing it when nobody wants to buy, they have to rent because they've got no money, nor are you going to try and get it next to a palace or anything like that, but good solid areas where people are renting, but they are aspiring to buy in the area as well. The reason that's important is if open market buyers, so people that search on Rightmove, Zoopla, on the market, etc., are looking to buy in that area, it will naturally push up the prices because the demand increases. So if we said year 1 here, this is the power. So year 1, you're going to do really well, okay? Because you've got the 1,800 plus equity. Equity is how much money is in the property. So if I sold that property today, how much money would I get back from it? Well, I'm going to get 120,000, which is great, but that's not in my pocket. Remember, I've got debt. I've got a mortgage on there of 90,000. So we're going to do 120 minus 90. It's going to give me equity of 30,000, right? So that's great. Is it in my bank account? No, so it's not quite as good, but it's as close to it as possible. So year 1, I'm going to get the 30K and the 1,800. So I'm doing 31,800. It will always be the best year, okay? If you've done this right, it will always be the best. However, from then, you can look at it and go 1,800, but here's where capital appreciation comes in, okay? And this is, if we go back right to the beginning, looking at the increase in capital value, here, capital growth, boom. So now we're gonna have all 3. Now, typically, and this is why people say you don't wait to buy property, you buy property and wait, because on average, property prices double every 10 years or so since the Doomsday Book in 1086 or whatever it was. I'm always getting that date wrong. 1086, I think. And it's doubled every 10 years. Does that mean you can look at every 10-year period it would have doubled? No, but in general it goes up over time, and that's the real thing. So let's say we're looking at 5% per annum, which in a good area is very good. In our area where we find property investments for our investors, we're getting 5% or above. We're actually getting 6 to 7% growth. But if we only got 5%, and it's growth on this number here, the value, this is where it gets quite a lot more exciting. So instead, if we do 5% of 120,000, that is £6,000, okay? So year 2, we're gonna get 6,000 plus the 1,800. So that's 7,800. And then year 3, we're going to do similar numbers, but now it's not worth 120,000. It's now worth 126,000 because remember it's gone up 6,000 in value. So now what's 5% of that? Now this just gets more and more complicated. So now it's going to be 6,300. Okay, so 5% of 126,000, £6,300. And then we're gonna add on the 1,800 into this, which is where it gets even more complicated for me, doesn't it? So 6,300, 8,100. So now you can see, and I'm not going to carry on doing this, but it increases as we're going along. So it should year on year go up. And that's not even taking account of the fact that rents also go up over time. So just remember, just to finish off this video, the 3 things you need to factor in when you are buying a buy-to-let is, number 1, can you get it at a good price? Can you get it below the market value? Even if you get a few grand off, it's really going to make a difference from the start and then moving forward. Number 1, BMV. Number 2, can you add value to the property? Can you do an extension? Can you extend at the back? Or quite simply, does it need a refurbishment? A new kitchen, new bathroom are some of the easiest ways to add the appeal and therefore value to the property. So we've got BMV number 1 and value add number 2. Number 3, and the most important, as you can see, as it is going to build up over time, is it in a high demand area? Because if it is in a high demand area, what you're going to find is that capital growth outstrips all of your other returns from number 1 and number 2. So make sure you're getting it BMV, adding value, and choosing a great area where people would want to live. And if you take this on, whether you're new or experienced, and retrain yourself around this, I promise you your first or next buy-to-let investment opportunity will be a good one. So thanks for watching this, guys. I really hope it's added value and given you the basic concepts of what a buy-to-let investment is and what you should be looking out for to maximize your returns and your profits for yourself and your investors if you're looking at other people's money. If you've enjoyed this, make sure to hit the like button. Of course, leave a comment. I'll make sure to reply to every single one. Any questions you've got around buy-to-lets or property or investment, I'll get those answered. And if you are interested in seeing more videos like this, make sure to smash the subscribe button, and I'll see you in the next video.